The U.S. Treasury is just about to do it. They're increasing the size of buybacks, Treasury buybacks. They're going to increase from $2 billion to $4 billion per operation, causing Treasury yields to fall, causing gold to spike up, causing the dollar to fall down, all as the U.S. government is nearing $40 trillion in debt. So how does this affect your bags? How does it affect Bitcoin? How does it affect stocks? What does this exactly mean? We'll talk about it in today's video. We'll also be going through a couple other things, including Paul Atkins, the head of the SEC, saying that they're going to take a historic step in crypto here soon. So keep in mind, today is the day where Trump is supposed to meet with a bunch of crypto executives. So we'll be going through that, along with something that I think is pretty interesting for anyone that wants to retire early. If you don't mind, hit subscribe so you can see future videos just like this. If you want to trade crypto or stocks, check out the links underneath the video in the link tree to BidFi and to Ubit. There you can start trading in just a few minutes. BidFi has this event going on every single month, actually, where anyone that's ever signed up through my link can get up to $10,000 worth of Bitcoin just for trading on the platform. The more you trade in futures, the more you get. So check that out underneath the video. There's also a link to Ubit. You can trade over 1,000 different assets on Ubit right now, including stocks, if you want to use leverage. So check that out. Now, as we can see, the market is a bit mixed today. The Nasdaq's down a little bit, kind of digesting some information about OpenAI growth rates not being as strong as previously expected. But we have the S&P 500 up a little bit and the Dow up a little bit. I think a lot of this is due to what the Treasury just said. They are going to double the size of their long end Treasury buybacks, which is causing yields to fall down, the dollar to fall down, and gold is moving up on this news. So over the past several years, one of the more amusing debates gripping the market's Fed watchers was whether the Fed Treasury buyback auctions were a form of soft quantitative easing. So this seems to be the case. Scott Bessent finally resolved the debate when, with 30-year yields at 20-year highs and threatening to blow out higher, the U.S. Treasury shocked markets and sparked a meltdown in yields and surge in equity futures and gold when it announced at 8:30 this morning they will be increasing by at least double the size of liquidity support buyback operations for longer dated nominal coupon securities, the 10 and 20-year sector and the 20 to 30-year sector. And the current maximum size of $2 billion per operation will be at least $4 billion. So the headlines are double. Keep in mind, before there's a maximum of $2 billion, now it's at least $4 billion. So it could be 2, 3, 4 times as much. They'll give more information about the buybacks at their next quarterly refunding, which is scheduled for November 4. So we actually have about 3 months before they need to really tell us what they're going to be doing. But this is causing a lot of change in the Treasury market. As we can see, we were at 5.3 just a day or two ago. Now we're at 5.2% on 30-year yields. The US dollar falling from 99.3 just yesterday, or just this morning actually, to 98.85, which might not sound like a big move, but almost a 1% move in a day is pretty sizable. So this is causing a bit of a change, and this is very good for risk on assets because it decreases the yield you can get on the longer dated treasuries, which decreases your risk-free rate of return. This is essentially quantitative easing. This is all coming as the U.S. debt is approaching $40 trillion. It just shows you need to be in assets because you're going to have your money inflated away, right? If you just continue to save and don't put the money to work, national debt continues to go up, the government continues to step in and provide quantitative easing, stimulus, all this kind of stuff, and prints more money. So yes, this is good for risk on assets. Now, is it good for Bitcoin? Yes. Will Bitcoin move up right now because of this news? Maybe, but I'm still expecting about a 65% chance that we could go lower. But if we don't, I'm okay with that. I'm dollar cost averaging as time goes on. I'm not trying to nail the exact bottom with Bitcoin. Now, that being said, Paul Atkins from the SEC just said that they're making a historical step to modernize federal security regulations for crypto assets. They want to be the crypto capital of the world. He basically points out, we used to do these well notices and we used to go after crypto companies. We want to be the leader. And they're trying to pass the Clarity Act right now. The government is, and hopefully that gets approved and we actually have some regulation moving into the next bull run that is, positive and allows companies to actually work with it instead of trying to just guess what the government wants and then get huge fines. Now, last thing, I'm trying to keep this short because I have to go to a live stream, but this is pretty cool. I think a lot of people, kind of forget why they're investing in the first place. And the goal of investing is to do what you want, when you want, how you want later in life. And for a lot of people, that comes in the form of retirement, being able to leave their current job and be able to live off their money. There's a whole group of people that are focused on this called the FIRE movement. And one aspect of the FIRE movement is coast FIRE. Basically getting to the point where you can coast, you can just take your foot off the gas pedal, and your investments will continue to grow in value enough that you can eventually retire in the future without having to contribute more anymore. So why would you want to do this? Well, let's say you're at a really stressful job, or you just hate your job, or you want to move somewhere and maybe start your own business. You can do that because you know that your investments will continue to grow. And even if you're taking a risk or taking your foot off the gas pedal, they'll get to the point where you can retire. So if you haven't thought about this before, maybe it's worth checking out. This is just a calculator I found called Coast FIRE Calc. Let's say you're 30 years old, you want to retire at 50, you spend $10,000 a year. Let's say you have $200,000 invested and you're contributing $10,000 a month. I realize this isn't everyone, but let's say you and your significant other have high paying jobs, maybe $150,000, $160,000 each. And then after taxes, you're able to put away about 50%. You could, assuming you get 9% rate of return and inflation's 3%, you want to withdraw about 4%. You could retire after, or you could coast after 8 more years. So maybe one of you can quit, or both of you can take lower paying jobs. You could still retire at 50 after 8 more years of contributions. I know that doesn't maybe sound too sexy, but let's say you had, $400,000 and you were just contributing $7,500. I know that's a lot, but you could still retire early, coast. And there are all different variations of this, but if you can get this bag, sorry, that was $40,000. I meant to hit $40,000. If you could get the current invested assets up higher, you're much closer to coast FIRE. And this isn't like hey, you can just put $10,000 away and then you can coast for the rest of your life. No, this is realistic based on actual rates of return that people typically see. Let me know your thoughts though underneath the video. I really do appreciate you watching. Again, you can check out BidFi or Ubit down below, and I'll see you in the next. Just a reminder, this is not financial advice. This is not legal advice. Do your own research. I'm never going to reach out to you either in the comment section or through any other means to try to get you to invest in something that I'm investing in or to send me crypto. Some links underneath the video are affiliate links. I may earn a commission, but this is at no extra cost to you. Of course, do your own due diligence.